Demystifying hedge funds. Navigating strategies and operations. 1. Introduction. Unlocking financial strategies. Hedge funds, often shrouded in mystery, play a significant role in the financial landscape. In this exploration, we delve into the intricacies of hedge funds, unraveling their structure, strategies, and operational dynamics. 2. Understanding hedge funds. Distinct investment vehicles. Hedge funds are investment funds that pool capital from accredited individuals or institutional investors. Unlike traditional investment funds, hedge funds employ a diverse range of strategies beyond conventional long-only investments. Accredited investors. Participation in hedge funds is typically restricted to accredited investors, individuals or entities with a high net worth or institutional investors. 3. Hedge fund strategies. Diversified toolkit. Hedge funds deploy a diverse set of strategies to generate returns. Common strategies include long, short equity, combining both long, buying, and short, selling, positions to hedge against market risk. Global macro, making investment decisions based on macroeconomic trends and global events. Arbitrage, exploiting price differentials in different markets or securities. Event-driven, capitalizing on specific events such as mergers, acquisitions, or bankruptcies. Risk management. A key feature of hedge funds is their emphasis on risk management. Strategies aim not only to generate returns but also to protect capital during market downturns. 4. Fee structure. Performance fees. Hedge funds typically charge both management fees, calculated as a percentage of assets under management, AUM, and performance fees, a percentage of profits generated. This performance fee aligns the interests of fund managers with those of investors. High watermark. Performance fees often come with a high watermark provision, meaning the fund must recoup losses before charging additional performance fees on new gains. 5. Operational structure. General partners and limited partners. Hedge funds often have a two-tiered structure. General partners are responsible for managing the fund and are usually the fund managers. Limited partners provide the capital but have limited involvement in the fund's operations. Fund administrator. Hedge funds typically employ fund administrators to handle tasks like accounting, valuation, and compliance, ensuring transparency and accuracy in reporting. 6. Regulation and oversight. Regulatory environment. Hedge funds operate in a regulatory environment that varies by jurisdiction. While they often face less regulatory scrutiny than mutual funds, recent years have seen increased regulatory oversight to address potential risks to financial markets. Due diligence. Investors in hedge funds conduct thorough due diligence to assess the fund's strategy, risk management practices, and historical performance before committing capital. 7. Liquidity and lockup periods. Redemption terms. Hedge funds often have specific redemption terms, restricting investors from withdrawing capital freely. Lockup periods, during which withdrawals are not allowed, can range from a few months to several years. Illiquidity of assets. Some hedge funds invest in illiquid assets, and as a result, investors may face challenges in selling their stakes quickly. 8. Performance metrics. Sharpe ratio. The Sharpe ratio, which measures risk-adjusted returns, is a common metric for evaluating hedge fund performance. A higher Sharpe ratio indicates better risk-adjusted returns. Drawdowns. Assessing the historical drawdowns, peak-to-trough declines, in a hedge fund's performance provides insights into its resilience during challenging market conditions. 9. Hedge funds and market dynamics. Market impact. Hedge funds can influence market dynamics, especially when employing significant leverage or engaging in crowded trades. Events like short squeezes or mass redemptions can have ripple effects on broader markets. Systemic risks. While individual hedge funds face specific risks, concerns about systemic risks arise when multiple funds are engaged in similar strategies or face simultaneous challenges. 10. Conclusion. Navigating complexity. Hedge funds, with their diverse strategies and operational nuances, present a complex landscape for investors. Understanding their structures, strategies, and risk management practices is essential for those considering allocating capital to these vehicles. As the financial landscape evolves, the role of hedge funds in navigating markets and generating alpha remains a fascinating aspect of the ever-changing world of finance.